Welcome back, everyone. We have breaking news this morning. We've been telling you about Dow Chemical raising prices by as much as 25% starting next month, also implementing freight surcharges. This comes less than a month after the company already said it would be raising prices by 20% to keep up with these higher energy costs. And right now we have the company's CEO, Andrew Liveris, on the Squawk News line with us this morning. And Mr. Liveris, thank you for joining us.
Thank you, Becky. Nice to be with you again.
It's very nice to be talking to you. We've been watching energy prices, and anybody sitting here could see the higher prices that have been coming through, but it has to come as a big surprise to many people that your company would have to come back and raise rates so quickly. What happened, and what's leading you to this move?
Well, the surge that occurred in June, Becky, I mean, we're now in the high 130-somethings, and pick your favorite number. But remember when we announced in May, it was in the 120s. Also remember that we take derivatives of oil and natural gas, and those derivatives have been escalating even at a faster rate than oil itself because, for example, naphtha competes in the gasoline pool, and right now people are still driving cars, albeit at a slower pace, but they're still driving, and so naphtha is rising and rising, and in Europe and the United States we're seeing levels north of $1,100 a ton, which is a year ago, that number was $400, Becky.
Wow. Should we assume, Andrew, that because you're raising prices again, those prices you were raising a month ago, those price increases actually stuck, customers paid?
Well, we in the main, we had a lot of stick, not fully. We've got 2,500 product families, so you got to understand we went up to 20%, and we got a substantial amount of increases, but this is just on top of up to as well. What you can see from that is 20, obviously do the math, 20 plus 25 is up to 45. Right. We fully expect that the numbers will be, in the 30, 35, 40 range, depending on the value chain.
I assume that some of your bigger customers you maybe spoke with before you put this press release out today?
Yes, we did. We had a heads up last night, lots of phone calls, also actually did a audio telephonic call to all of our distributors. We are doing it regionally. It does depend on the region. So, for example, we've added this freight surcharge this time around in the United States. We can do that here because of the nature of moving products around, much more trucking here than, say, in Europe or Asia.
Mr. Liveris, you're also cutting back quite a bit of production on some of your key products. The combination of higher prices for what you do still produce and sell, along with what you save with the cutback in production, are you comfortable that you're going to do that $3.40 number for 08? Will these moves allow you to hit targets?
Well, Joe, we don't do, that's an analyst consensus number you're using, and we don't confirm nor deny. We don't do guidance on the number. But the guts of your question, we're idling capacity as much as for supply demand, but more critically covering cash costs. You'll notice a lot of those products use their first derivatives of petroleum, and when you can't run the plant and make positive cash costs, you just have to bring it down. And so with naphtha and ethane and a lot of key inputs so high, this is just idling a capacity until those numbers drop. Maybe they'll never drop, but maybe we're seeing this now for as far as the eye can see. So let's call it managing the assets so we don't make negative margin when we run them. Now, to your point, why we're doing all this is by taking down assets, by raising prices, getting as much of it to stick as we can. We're fundamentally moving ourselves to where we can not be swallowed by this massive surge. So not that we give guidance, but obviously you can see what we're trying to do, which is to maintain our earnings.
Maintain your profitability. I mean, do you think that given what you're doing, will it offset everything, or do the numbers need to come down in your view?
Well, I've been watching with great fascination, as I'm sure you all have in the last year, how steel and iron ore and a lot of the minerals, a lot of the, let's call them other commodities out there, fundamentally are affecting downstream. And, why don't you consider this the first wave of downstream in oil and gas? I mean, in essence, those products that are commodity-like in the chemistry chain, petrochemistry chain, cannot stay where they are with these input costs. So we're treating them like commodities. And, the commodities means that where there's demand, the prices will go up. Where there's no demand and we can't match the surging inputs, we'll take down assets.
Last time you were on, Andrew, you intimated that rivals, other suppliers were thanking you for taking the lead on these price increases because it gave them cover to do the same. If rivals don't follow you, though, how much market share would you be willing to lose as a result of these new prices? At what point would it no longer be worth it?
Well, Carl, a lot of things have happened in this last 6 weeks. So I'm not sure I'm the friend of every customer out there, but I would tell you that there's a lot of companies that have followed